Hello and welcome to Bondcast, a podcast series where we discuss the latest themes and events shaping rates markets. I'm Ian Vanderhorn, a US-based macro strategist, and I'm joined here today by our global market specialists, Paul Robson and Oriane Parmentier. Paul, let's start with you over in the UK. Last week we spent a good bit of time talking politics. Maybe just a quick update there. Has it subsided over there, or what's your take on the political situation right now?
Yeah, it does feel like the political uncertainty that reared its head last week subsided almost as quickly as it sort of escalated, and certainly quite shortly after we recorded the last episode of Bondcast. It felt like the risks were receding somewhat. There was support for the Prime Minister from the Cabinet and senior leadership officials in the Labour Party, which I think soothed market concerns. And certainly over the past week, gilts have performed reasonably well, or at least in line with global bond markets. There wasn't any follow through. I think the risks do just sort of simmer in the background, if you like. Never know with these things what kind of deals or concessions or timings, I think, are unclear at this point. We still think that those political risks that in the past have been important for the bond market and have weakened gilts and cent yields higher. There's a couple of risk events through the first quarter and then into the second quarter. The most obvious one that stands out that could be a lightning rod for political worries is the Gaunton and Denton by-election at the end of the month. But then in a few months' time after that, we've got the May 7th local elections. We do have the spring statement that's sort of sandwiched between those two political events, but I don't think that that's going to be significantly market moving. I think the main focus there will be on the DMO's remit for 2026, 2027, and whether they continue to skew issuance shorter, which I think that they do, and there'll be interest in that as well. Sentiment around gilts, I think, will be a function of how the government performs in those two elections dates. I think that matters. As I said last week, the reasons for the political instability, I don't really need to go into. I just reflect on historic correlations, and they've been pretty stable over the last couple of years. I don't think there's any reason why correlations would change into the future. If people worry more intently about leadership change, I think it quickly turns to fears over a dilution of fiscal policy, weakening of the government's self-imposed fiscal rules, and the implication of greater bond supply at a time when there's an awful lot of supply around. It's all been front-loaded, but it's going to be a steady theme throughout 2026, and it matters. You get a greater inflation premium and just a general term premium rises as well. So it's ebbed back a little bit, but I think it's going to be with us for much of H1 of this year.
Sounds right. Sounds subdued, but a couple, events on the horizon that we could be looking towards. But let's switch over to the data this week in the UK. Why don't you walk us through that? Has that changed your perspective at all, particularly on the front end of the gilts curve?
It hasn't changed our view, certainly on the path of Bank of England policy rate changes. We still think the next move from the MPC comes at the April meeting. Markets are more confident that next rate cut comes at the March meeting. They've got 18 basis points or 25 basis points price for March. We could conceivably have a rate cut in March instead of April, but we just don't think there's enough time for the MPC to get clarity on a couple of key points. So remember, Bailey is the swing voter on the MPC, but also Man seems to have shifted somewhat. But she notes that some of the variables that are important to inflation are still above levels that are consistent with price stability. So we'll be watching her comments and obviously Governor Bailey interpretation of recent data. In terms of that data, they were relatively mixed. I don't think they moved the needle significantly. GDP numbers for the last quarter of last year and the December month-on-month print were a little bit weaker than expected, but not dramatically so. And also, remember the budget for last year came at the back end of November, so there would still been some lingering issues, I think, about sentiment and worries at the end of last year. So hopefully we'll get a little bit more strength. Some of the second tier employment numbers, the REC survey, held up much more strongly or at better levels than the official data. The official data have softened in terms of job growth and then job losses, unfortunately. We do get key labour market data, official data, next week, and we'll be certainly watching to see what's the trend in payroll jobs, because they do get revised as well, even though these are the companies informing the Inland Revenue about who will be paying tax. It is still a sample and they don't get all the information straight away. And nothing's really changed watching those labour market data. I think that they'll be the main focus next week.
How about anything else? Anything outside of politics or data that I neglected to ask? Anything we should keep an eye on?
Yeah, I think there's just a number of things for gilts that are worth keeping an eye on. Obviously, this week there's been a big focus on corporate supply, and there's also been renewable energy contracts being awarded by the government, and whether that's hedged or not hedged and how it impacts the market. I think that that's something that we need to keep an eye on. The market should become a little bit cleaner from here. I said the same last week, actually, but it seems to have just lingered a little bit longer. But supply, the cleaner driver of sentiment, and we think that will be skewed to the short end ultimately, or below the 10-year, and therefore that's where the pressure will be. Another point, just the carry trade in global fixed income markets. It's really interesting that global macro rates vol remains low, while you get some quite high vol in equities, in FX, in precious metals. And I do wonder whether the difference between that and the bond market is retail participation. But if macro vol or rates vol stays low, then carry is going to be of interest. And of course, the UK's longer end yields are higher than most, so I'll be watching that. Be watching cross market, looking at the US very carefully. I'll be super interested to hear what you have to say about recent data in the US and what you're thinking. But those are the key drivers, I think, that sort of corporate supply, renewable energy, sort of cleaner supply, carry and cross market things. But we continue to be more bearish on gilts than the consensus. So we still think 10-year yields go higher from here through the first half of the year.
Yeah, the vol carry story is certainly an interesting one over here in the US as well. But you mentioned supply also, and I'm going to use that as the segue to move over to Oriane, actually. Oriane, not much data in the euro area this week, but I believe the focus was on supply more broadly. Is that right? And maybe walk us through that.
Yeah, sure. So there was quite a bit of focus on supply and in particular on 30-year supply this week because Germany conducted an auction on the 30-year sector, and France as well syndicated a new 30-year. Actually, books for this new 30-year France were historically high for 30-year bonds. I would say that overall, this kind of 30-year supply has been well absorbed across the board, and we did see curve actually flattening on the day of the auctions and syndication. So I think, we're still keeping in mind that 1030s have steepened since since the beginning of the year, in line with our views. But I would say EGB curves have been relatively well behaved this week in a context of, so much long dated supply, and quite importantly as well, it's been long dated supply not just across sovereigns, but across assets as well. For me, the kind of like medium term theme remain the same. We have a lot of supply across EGBs this year, again, long dated supply as well. If you look at the weighted average maturity of issuance from France or Germany, which are the largest issuers in EGBs, it's been actually relatively long dated, I would say, and it's been increasing steadily over the past sort of years. So while some countries such as Spain or even the EU have been able to reduce their weighted average maturity in the past years, it hasn't been so much the case of the largest issuers, and in particular Germany. We also do, have this story of structural shift in demand for the long end in the background, with the transition of the Dutch pension funds, of course, which I think adds also to the theme. So we stick to our steepening views, continue to like tentativeness in Europe. And aside from supply, as you mentioned, not much data this week. I think perhaps worth noting that we have the EU summit with a focus on regulation and defense in Europe. I don't think, today's summit is expected to be particularly market moving at all, especially as the conclusion are perhaps expected at the European Council meeting, which is a bit later, beginning of March. There's still important focus on topics such as defense and, the potential increases in joint EU debt issuance. I think the theme continues to be, a gradual one, as usual for any European topic, I would say. But the expectation here is that there will be eventually additional each EU issuance in the coming years. And for, I think, two main kind of things here. The first one is that for EU as an issuer, more issuance should help strengthen its sovereign-like status in the market. And the second one, also worth noting, is that anything leading to more Europe in general or more Eurobond, I think is good for spread. So periphery spread in particular, I would say, and one of the reasons why we are still very much constructive on these.
That makes perfect sense. The focus here in the US was actually sort of the inverse. We had both supply and a good slate of data, and actually it was the supply that sort of faded into the background. We had the 3-year auction, the 10-year auction yesterday, and then we have the 30-year auction later this afternoon. We're recording on a Thursday. 10-year auction did not go so hot, but I believe that was really due to the data released earlier in the day, which was the focus in the US this week. It was a jobs market report for January that had been delayed a little bit due to the government shutdown at the start of the month. But the number came in, I think, a lot stronger than expected, and that was really the focus for our markets. It was a strong beat in employment pretty much across the board. We had a lower unemployment rate. It fell a tenth down to 4.3%. As I mentioned, we doubled the amount of expected jobs. There were 130K jobs added versus 65K consensus ahead of time. And we had stronger wage growth than was anticipated as well. So really, a three-peat in terms of strong results. I think it was even a little bit more surprising for markets here, just given that I think markets were a little bit ready for a weaker number, even perhaps weaker than consensus. We'd heard from a few Trump officials, in recent days, sort of warning us that the jobs number could come in a little bit lower in the coming months. They were talking about things like, lower immigration, increase in productivity. They were essentially, at least in my eyes, softening the beach for jobs numbers to come in somewhat weaker indefinitely. And instead, we got the exact opposite of that. We got a conclusive beat, and like I mentioned, headline payrolls was very strong, and the private payrolls, portion of that, which excludes government workers, was even stronger. There were 170K jobs added in the U.S. economy, and that's the most in over a year. It's the most since December 2024. So for markets, the initial knee-jerk reaction was to pare back expectations for Fed easing. I think that's natural and right. Market pricing for the first cut, or I should say the next cut in 2026, got pushed out of June and into July. So we moved back a meeting. But I would say, I must admit, in terms of the curve outside of Fed pricing, I was a little bit surprised at just how subdued the move was. We had the knee-jerk higher in yields in the front end of the curve, but it was pared back, through the remainder of the session. It was a little bit surprising just because, the week prior we had a string of weaker labor market data, job openings data, layoffs data, called challenger job cuts, and then the usual jobless claims data. That all came in softer, and markets, rallied in the front end. And we did not come close to reversing that move yesterday with the January payrolls. And, I think that's telling. Our trading desk also told us that they saw some dip buyers emerge. A lot of their real money and/or central bank clients were using the opportunity to re-engage and get long in the front end of the curve. In my view, that really speaks to perhaps there being some skepticism around the strength of the January jobs report here in the U.S. Part of the reason for that, we were also given the final reading of the annual benchmark revisions. And those concurrently confirmed that jobs were, vastly overstated in the 12 months ended March 2025. So dated data, but nonetheless confirming, that job growth had been really overstated in the US. And that's the second year of this, scale of revision. Close to 900K is quite a lot, of course. And I think that it set up markets to be a little bit distrustful of any strength outside of trend, I should say, when considering these types of revisions. If I just use last January 2025 as an example, the initial reading for that month was strong, over 100K, and it's since been revised into negative territory. So a month of job losses. So I think markets are just a little bit cautious here to read too much into just how strong that payrolls number was. Another point of caution that comes to mind, but has been a trend here in the US in terms of job growth, is that once again, nearly all of the job gains were sort of concentrated in one industry, the healthcare industry, or at least the healthcare industry and other sectors somewhat related to it. So the job growth isn't, very even, and we do have industries that are shedding jobs concurrently and or not growing at all. But I guess you can't discount the other clear positives that were there as well. The fall in the unemployment rate happened for the quote unquote right reasons, as our economists would say. Right reasons being we had growth in the labor force and we had fewer unemployed people. So together, those will push down the unemployment rate. And something that just stuck out to me because it's been mentioned by Fed Chair Powell before is that we also saw a drop in the unemployment rate among younger college graduates, a near 1%, or actually a true 1% drop in that unemployment rate. So perhaps some, real reacceleration in a cohort of job seekers that have been struggling a bit recently. So yeah, I think the market, I guess, discounted this number just a little bit. It said the signal that for Fed easing to be pushed out even more, there might need to be a little bit more, you know, evidence of labor market strength, a little bit more evidence to push back against some of the weakness we've seen recently. In other words, we'll probably need to establish more of a trend before views need to change a little bit more. And that includes, ours, I would say. If I just think about what this number means for our view, initially it doesn't mean a whole lot, especially when taken in context with, I guess, the rest of the US data, which has been pretty Goldilocks, I think is the word that's being thrown around recently. It's good enough to keep the Fed on the sidelines for now. Any signs of weakness really don't seem to scream cut rates, or certainly cut rates before June. So yeah, we still hold the view economy is resilient, growth is resilient, and our Fed call is unchanged. We don't think there will be a Fed cut while Powell is still at the helm, and we continue to expect the next cut to come in June when the new chair, be it Kevin Warsh, takes over. So let me leave it there today. If you enjoyed the podcast, as usual, please remember to like and subscribe, and we look forward to recording again next week. Thank you.